This investment strategy is for investors who simply cannot sustain any significant losses and are looking for a very conservative approach to growing their investments. Warren Buffett, America's most successful investor, famously said, "There are only two rules in investing. Rule number one, don't lose money, and rule number two, don't forget rule number one." But over the past few years, it seems that everyone on Wall Street, the big banks, the major corporations, stockbrokers, financial planners, and of course the US government all forgot rule number one. If there was ever a good time to consider a new investment approach, it's when the old ones have proven so fallible. I've always believed that every investor should have their retirement savings divided into two separate investment portfolios. You need it for your peace of mind. If you want to sleep well at night, it is really important that an investor has two separate investment accounts. We call this the two-portfolio strategy. The first portfolio should be a conservative, all-weather portfolio. This portfolio should hold only that percentage of an investor's capital that they would want invested in a very conservative investment strategy and that would attempt to limit any significant losses in market corrections or in long-term bear markets. The second investment portfolio should hold that percentage of an investor's capital where an investor is willing to take a larger calculated stock market risk and is willing to accept a higher portfolio volatility. As I mentioned earlier, this two-portfolio strategy allows an investor to sleep well at night, knowing that the money with which they just cannot afford to sustain any significant losses is invested in a conservative, all-weather strategy. And yet they still have another portfolio invested in the stock market and designed to accept a higher calculated risk and hopefully more substantial growth. Look, the stock market is inherently unstable and volatile. You all know that. In the 2000 to 2002 bear market, the S&P 500 index dropped peak to trough 48%. And in the 2000 to 2008 bear market, it dropped by 57%. For the 13-year period from 2000 to mid-2013, the stock market basically just broke even. For American investors, it's been more than a lost decade. After two booms and two busts, the stock market has earned them nothing, or after inflation, less than nothing. And it's very hard to retire if your investments are not working and earning any money over a 13-year period. Now, everyone talks about the magic of compounding when you are making money over time, but they never tell you about the dirty little secret about the disastrous consequences of negative compounding, or what is sometimes called the mathematics of loss. The mathematics of loss works like this. If you buy a stock or a mutual fund for $60 and it drops to $30, that's a 50% loss. But to recover your loss and get back to break even at $60, your investment must go from $30 to $60, and that is a 100% gain. For most investors, this kind of after-the-fact recovery of their lost investments, it's really difficult to do in any short period of time. Since the U.S. stock market has only increased on average 7 to 8% per year over the long term, that means it will take almost 12 years to break even on your investments. So what is it that investors really want? Ideally, investors are looking for an investment strategy that, one, protects them from drops in the stock market during bear markets, and at the same time provides them with steady growth in their portfolio every year higher than the rate of inflation. Now, as I mentioned before, I believe every investor should have their retirement savings divided into two separate investment portfolios. Every investor should have one investment portfolio they can monitor every day that holds the core percentage of their investments that they simply cannot afford to sustain any significant losses. This should be an investor's permanent portfolio, which is designed to hopefully ensure that your retirement assets are safe and working and will outlive your life and that of your spouse. This is that percentage of an investor's portfolio that should not sustain any significant losses if we once again experience bear market declines like we saw in 2000 to 2002 or 2008 and 2009. The permanent portfolio is designed to hold 4 broad investment allocations that are not correlated to each other or to all in economic environments. Now, this ensures that any event that damages one investment should offset and be good for one or more of the others. And no investment allocation can devastate the entire portfolio because no investment has more than 25% of the portfolio's broadly diversified capital. Now, this second investment portfolio that every investor needs to set up separately should hold that percentage of an investor's capital where an investor is willing to take a larger calculated risk in the stock market and is also willing to accept higher portfolio volatility as the stock market moves up and down. This 2-portfolio strategy allows an investor to sleep well at night, knowing that the money they just cannot afford to sustain any significant losses is invested in a conservative all-weather strategy, and yet they still have another portfolio invested in the stock market designed to accept a higher calculated risk and hopefully the possibility of substantial gains and higher growth. Why is a risk assessment questionnaire imperative for all investors? At our company, Fairfax Global Markets, every potential client must answer for themselves the following 2 questions. The first question is, what specific percentage of your investment capital can you just not afford to lose any significant amount of your investments? The second question is, what specific percentage of your investment capital are you willing to take some calculated risk and accept a higher degree of volatility in order to achieve some growth and hopefully a much higher investment return? Now, studies have shown that when the client, rather than the investment manager or the financial planner, determines the percentages of each portfolio, the investor is far more likely to stay the course. Here's how the permanent portfolio strategy works. And again, let's be clear, the permanent portfolio strategy is designed to hold the money that an investor simply cannot afford to sustain any significant loss in their investments. This strategy was first invented in the late 1970s by the free market investment analyst Harry Browne. This investment strategy basically holds 25% of the portfolio in stocks, 25% in short-term treasuries, 25% in long-term bonds, and 25% in gold and precious metals. This conservative, all-weather, broadly diversified asset allocation is designed to protect an investor's capital under any and all sets of economic conditions. These non-correlated investment allocations are designed to work during both bull and bear markets and in periods of inflation, deflation, and also in periods of recession and depression. On top of all this, at Fairfax Global Markets, we add an additional layer of risk management. On top of all this, at Fairfax Global Markets, we add an additional layer of risk management. When one of these 25% asset classes declines below their long-term 200-day moving average, that allocation is moved to cash as a component of the Fairfax Global Markets active risk management strategy. Here you see how gold started to dip below its 200-day long-term moving average, the blue line, in late 2012 and in early 2013. When that happened, we moved the 25% that was invested in gold in the permanent portfolio strategy to cash or short-term treasuries so that clients did not have to sustain the loss shown above. When gold moves above its long-term 200-day moving average blue line, we will again reinvest the 25% allocation in gold. That's why the permanent portfolio investment methodology works. 25% of the portfolio is generally invested in global stock ETFs to provide a strong return during bull markets and periods of prosperity. 25% of the portfolio is generally invested in long-term Treasury bond ETFs, which do well during periods of prosperity and during periods of deflation. 25% of the portfolio is generally invested in short-term 1 to 3 year Treasury bond ETFs, and these, much like cash, this allocation hedges against periods of tight money in a recession or a depression. And lastly, 25% of the portfolio is generally invested in gold and precious metal ETFs in order to provide protection during periods of inflation. You know, in Greek mythology, the Hydra is a serpent-like creature with numerous heads. Each time an opponent cuts off one of the heads, 2 new ones grow back. Harm is what it likes. The more harm it encounters, the stronger it becomes. There are so many things outside of our control that can negatively impact the stock market. I mean, you know what they are. They're politicians, Mother Nature, Middle East conflicts, crazy countries with dictators like Syria and North Korea. These can all negatively affect global stock markets. Investors today need an investment strategy that is not only robust, but is one like the Hydra. You can't kill it. When you cut off its head, 2 heads come back. It comes back even stronger. And the permanent portfolio is a Hydra-like strategy. Each of the 25% allocations is designed to thrive in a different stock market environment. It is this Hydra strategy that is designed to lower volatility and provide some aspect of growth in all stock market environments. This chart compares the performance from December 31st, 1972 to June 30th, 2013 for the permanent portfolio strategy using the 200-day moving average versus the permanent portfolio strategy using a buy and hold strategy. This 40-year performance chart has been provided courtesy of Mabane Faber and is used with his permission. Mabane Faber is an economist that has popularized the 10-month 200-day moving average system in his book, The Ivy Portfolio, How to Invest Like the Top Endowments and Avoid Bear Markets. For this performance backtest, stock market indexes were used to represent the 25% allocations in each asset class allocation. In many cases, index mutual funds and exchange-traded funds, better known as ETFs, were not created or in existence in 1972. So that is the reason indexes were used for this backtest. Also, there were no investment management fees or trading costs deducted from this backtest. For stocks, the S&P 500 index was used. For gold, the gold price index was used. For long-term Treasury bonds, the 30-year Treasury bond index was used. And for short-term Treasury bills, the 13-week Treasury bill index was used for the almost 41-year period from December 31st, 1972 to June 30th, 2013. The permanent portfolio using the buy and hold strategy performance represents the performance of buying and holding the 25% allocations of each of the 4 asset class indexes during this period. The permanent portfolio using the 200-day moving average performance was calculated when an index in the 4 asset classes fell below its 10-month or 200-day long-term moving average at month end. The position was sold and held in cash. Treasury bills were used as substitutes for cash. When it closed the month above its 10-month moving average, the index was purchased at the stated allocation. I'd just like to make clear that the chart and performance above is an independent backtest from December 31st, 1972 to June 30th, 2013 of the permanent portfolio strategy and does not represent the actual returns of the Fairfax Global permanent portfolio strategy. Our track record does not go back to 1972, so please contact us at Fairfax Global Markets for information on our portfolios. During the 41 years of this back-tested performance, the permanent portfolio using the 200-day long-term moving average has had a compounded annual average return of 9.38%, which is just slightly lower performance than if an investor stayed fully invested during all that time in the S&P 500 index, which returned just a slightly higher 9.93%. But the advantages of being invested in the permanent portfolio using the 200-day moving average over just being invested in the S&P 500 index is you would have had a much lower beta, much lower risk, and the permanent portfolio using the 200-day moving average has only had one negative down year in 1990 when the strategy was down just 2.6%. The maximum drawdown during any period for the permanent portfolio using the 200-day moving average was just 8.13% versus 50.95% drawdown for the S&P 500 index. Again, this is the kind of portfolio that lets investors sleep well at night, and they haven't experienced the sharp bear market declines that drive most people crazy and often drive them right out of the stock market. Now, here is how the second portfolio, the calculated risk portfolio strategy, works. This is the client's second investment account that every investor needs to open. We call it the calculated risk portfolio strategy, and at our company, Fairfax Global Markets, we always suggest the Fairfax Global Value Stock Portfolio. This investment strategy is designed to tactically invest in undervalued value stocks with 1, low price earnings ratios, 2, high returns on equity, 3, high free cash flow generation, and 4, rising momentum. This value stock strategy takes more calculated risk and will have more volatility because of the stock market, but during bull markets, it should outperform. As you can see, for the 1 year from June 30th, 2012 to June 30th, 2013, this value stock strategy was up over the S&P 500 index, even after investment fees were deducted. The benefit of this two-portfolio strategy is that investors can review their portfolios every month and see their Fairfax Global Permanent portfolio is hopefully growing a little every month and doesn't have any wild swings in value or volatility. And they can also see their calculated risk portfolio, the Fairfax Global Value Stock Portfolio, and the investor understands this portfolio will have more volatility associated with the stock market, but it will also have more potential for higher growth and larger gains. Look, here's the bottom line. If you are not a day trader and you don't want to gamble your retirement savings away, and you are sick and tired of politicians wrecking our economy and Middle Eastern wars and upheavals, natural disasters like tsunamis and bear markets driving the stock markets up and down, then you need an investment strategy like I have outlined today. Always remember investment rule number 1, and you will at least not sustain any significant losses to your investment capital ever again. There can be a safe way to grow your retirement savings. You just need the right two-portfolio strategy. I'm Paul Dietrich at Fairfax Global Markets, and thank you for watching this seminar.